Disney is one of the largest entertainment companies on the planet, and the company has just reported that their streaming service Disney Plus has reached 95 million subscribers. And across all of their platforms combined, the company has now more than 146 million paid users. So this has led to analysts crowning Disney as the king of streaming. And in this video, we're going to analyze Disney stock, go over their most recent earnings report, and take a look at the company's future growth potential and discuss Wall Street's expectation for the company going forward. And before we do that, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and sell, and any major market news. So please hit that like button, subscribe to the channel for daily videos, and today we're going to talk about Disney, the new crowned king of streaming. And the company just shared their latest quarterly results and beat analyst expectations for both revenue and earnings per share. And if we take a look at the numbers, their top line revenue came in at $16.25 billion, beating the expectation that was set at 15.9. And what was really impressive is that their earnings per share came in at 32 cents versus the expectation of a loss of 41 cents per share. So revenue they beat on the top line, and earnings they absolutely crushed the analyst expectation. They were predicting a loss of 41 cents, but Disney posted profit of 32 cents per share. And that was really led from the success of their streaming services. And right now the company shared that they have almost 95 million paid Disney Plus subscribers. And going forward, they still have a ton of room to grow as they expand internationally. And right now the company has also shared that across all three of their main streaming platforms combined, they have more than 146 million paid subscribers, which is absolutely incredible. And compare that to Netflix, who has just over 200 million, Disney is fast approaching their greatest competitor. And ESPN and Hulu saw 26% growth over this latest quarter as well. And of course, overall, the direct-to-consumer business for Disney saw record-breaking growth of 73% over the same quarter last year and was up to $3.5 billion. And the success of Disney streaming services is what's really driving the share price even higher. It currently sits at $187 per share, which has grown 32% over the trailing 12 months. And the current market cap on this company is at $340 billion. So right now Disney is globally known for their theme parks and attractions. But with the global pandemic, those have been completely shut down. And that has really been hurting the company's bottom line. But the success of the streaming is really keeping the company afloat. If we just take a look at the numbers, over this latest quarter, the park's revenue at Disney was down 53% to $3.58 billion. That's because most of their theme parks all across the world were shut down or operating with reduced capacity, and all of their cruise ships and guided tours were suspended. But analysts are still very confident in the potential reopening of the park's network very soon. Right now, we see the light at the end of the tunnel. We have multiple vaccines on the market getting widely distributed each and every day. And at this point in time, we're expecting over the next 12 to 24 months the reopening of Disney parks all across the globe, bringing back in a very profitable aspect of the Disney ecosystem. And if we take a look at this quote from one of the leading analysts who is actually bullish on Disney, this is what they have to say. The vaccine progress, pent-up demand, and pandemic-driven cost efficiencies position the park segment for a strong rebound in fiscal 2022 and record profits in fiscal 2023. So they're expecting over the next 2 to 3 years, not only a rebound back to pre-pandemic levels, but record-breaking profits for years to come. And another article reads, with a likely return of its dividend, bringing back income investors in 2021, continuing momentum for Disney Plus going forward, and at least the start of the recovery next year, Disney makes sense here. Disney stock is a buy. So overall, analysts who believe that we're going to see a reopening of the economy very soon over the next 2 to 3 years are predicting that Disney will be a much larger company over the next few years in the future. And one thing that I want to share, although we've seen tremendous performance of Disney Plus, reaching 95 million paid subscribers, that aspect in the direct-to-consumer business is nowhere near its peak. Overall, analysts are now predicting between 230 and 260 million Disney Plus subscribers by 2024. So that means they're going to 3 to 4x their current numbers over the next 4 years. And another point that I want to share that really shows how successful Disney Plus has been is that when the company first launched the service, over the first 5 years, they were predicting between 60 million and 90 million paid subscribers. But now, that now sits between 230 and 260, and within a 1-year timeline, they achieved their high end, which was their original estimate, over the next 5 years. So what they were expecting to do in 5 years, they did in 12 months. That's just how much of an impact and how successful this platform has been so early on in its development. And in 2021, we're still expecting some mass expansion of their total subscriber base, because the platform is now expanding into Eastern Europe, South Korea, Hong Kong, and many more markets over this calendar year as well. And analysts really like the plan that Disney has set out, and some of the largest investment firms on Wall Street have been raising their Disney price targets. If we take a look, JP Morgan Chase raised their price target to $220, up from $210. And we have KeyBank raising their price target to $225, representing more than 20% upside from the current level. And if we take a look at an analyst report, they have Disney as a buy, 6 strong buys, 16 buys, and 7 holds, and no one is selling out of this company. And over the past 6 quarters, we've seen 5 positive earnings surprises, and of course at the height of the pandemic, they did miss on EPS estimates. And going forward, we're expecting the annual revenue to grow at a massive rate. We're forecasting 7% growth in 2021 with over 32% growth in the next 2022 fiscal year. And if we jump over to Yahoo Finance, their analysts are predicting 23.5% growth in total revenue over 2022, bringing up the total top line to over $86 billion. And with this top line growth, their net income is expected to grow at a massive rate as well. If we jump over to Simply Wall Street, they're forecasting 38% earnings growth for the next 3 years in the future. And if we take a look at where we are today, of course the decline due to the pandemic, from this low point, we're only expecting increases in not only revenue, but earnings for many years in the future. And as we can see, by 2025, we're predicting over $111 billion of revenue with over $14 billion of net income. So their total bottom line is only going to grow at an exponential rate and follow the trend upwards over the total revenue. And we can see total revenue is only growing exponentially as time goes on. And if this company can achieve over 300 million paid subscribers, they will be a massive player in the entertainment space, much larger than where they are today. And with regard to overall share price, Yahoo Finance is predicting over 41% growth each and every year for the next 5 years in the future. 41% per year growth would be absolutely incredible from this mega cap company. And now we're going to wrap up by taking a look at their financial statements. If we start off with the income statement, year over year, before the pandemic, Disney continued to grow, bringing in just under $70 billion of total revenue. But we can see, of course, in 2020, a little bit of a decline, and of course, in the trailing 12 months, that decline continues to around $60 billion in total revenue. So even for a company when one of their main business segments, the parks, was completely shut down, they were still able to generate $60+ billion of total revenue in the trailing 12 months. And now if we take a look at the bottom line or the net income, we can see a sharp decline in profitability. Before the pandemic, they were extremely profitable, bringing in over $11 billion in 2 consecutive years. But in 2020, they had a $2.8 billion net loss, and in the trailing 12 months, that is now up to close to $5 billion in the red. Of course, these are only short-term losses, and we're expecting the company to rebound post-2021 and beyond. And if we now take a look at their balance sheet, overall, they've been bolstering up their short-term financial position. We can see their cash has gone up to close to $17 billion compared to where they were before the pandemic, averaging between $4 and $5 billion. And right now, we can see that Disney has total current assets of over $34 billion. So if we compare that to their short-term liabilities, that comes in at $26.5 billion. So over the short term, their financial position is very strong, a current ratio well above 1, and no worry about any short-term liquidity issues coming from Disney over the next 12 months. But if we take a closer look at the balance sheet overall, the company has over $201 billion of total assets, and if we compare that to the total long-term debt, we can see a total of $103 billion. So off that look, we can see that the company is very strong. But if we dive deeper, in the total assets section, we can see goodwill and other intangibles make up a significant portion. And these two added together represents $95 billion of total intangible assets. So essentially what that means is they have $95 billion of assets on the balance sheet that cannot be liquidated for cash at any point in time. And that affects the tangible book value of the business. So if we take a look at the bottom, right now, this company has a negative tangible book value of $12.3 billion. So essentially, the total assets on the balance sheet that can be liquidated for cash at any point in time are not enough to cover all the debt that Disney has on the balance sheet as well. So usually this is not a strong sign, and this is something we want to avoid. But Disney has been operating like this for the past 2 years, and before that, they were a positive tangible book value of over $10 billion. So they have increased their debt as of late, their goodwill has gone up, and as a whole, this really is not the strongest sign for the financial position of this entertainment giant. In no way am I worried about this company going under. They'll be able to manage their debt just fine, but just to point out, their total assets of over $200 billion are highly inflated with $95 billion of total intangibles. And the actual tangible book value of this company is in the red by $12.3 billion. So as a whole, Disney's income statement was growing very nicely before the pandemic, and then of course revenue and income has taken a big hit. In the balance sheet, their short-term position is strong. Over the longer term, they still have some work to do to get it to a more safer position. But overall, not the worst financial statements by any mean, but in no way the strongest, even at this point in time. So overall, Disney, they've seen tremendous growth as of late because of their subscriber growth. Disney Plus has really turned this business around, because if this wasn't so successful, we would not be talking about Disney with this much positivity. And the future expected growth of all three of Disney's streaming platforms, including Hulu and ESPN, is really what's driving the investor confidence and setting the share price to record highs. So right now, if you're thinking about buying Disney, take into consideration the current financial position that we talked about, the future expected growth of these streaming services, and the potential reopening of the parks at the end of 2021, 2022, and beyond. So Disney at this current point in time has seen a massive run-up. But if you invest long-term and you believe companies are going to be bigger and badder over the next 5 to 10 years, then this may be at an attractive level. And in my personal perspective, I think over the next few years, once this streaming services only continue to grow, if they can hit 250, 300 million subscribers over the longer term and have all the parks fully open and operational, this company will be at a whole nother level, way above where they are today. And I can absolutely see this company being worth over $500-600 billion over the next 3 to 5 years if they continue to grow at the same rate that we're seeing and the overall economy has a full recovery. So definitely take a look at Disney. This was our quick little analysis on the company. They just reported their latest earnings and beat on the top and bottom line and posted record growth in their subscriber base. So I think Disney has completely changed the game. I think they're more of a streaming platform rather than a traditional entertainment brand. And as a whole, I think Disney will still be a main name in our society for decades in the future. So thank you for watching, everyone. I am the Gen Z Investor. We post all about the stock market every single day. So please hit that like button, subscribe to the channel, and see you in tomorrow's video.